If you're looking to load up on any one individual stock or at least add some real winners to your portfolio, I am here to share 6 dividend stocks that you should absolutely be considering to get the ROI job done right. Now, one of these stocks I personally just bought thousands of dollars worth just within the past 2 weeks. 2 others I've actually been dollar cost averaging into by the hundreds as of the last few weeks. And then there's 3 others that are on the top of my watch list given their sheer power to deliver through on explosive growth in the form of share price appreciation and dividend growth. Now, before I run through these dividend stocks, it's actually most important for you to understand the angle that I'm coming at them with, which deals heavily in our economic environment. So first and foremost, I am naturally an optimist, and I do believe that the future will be better than our past, or at least better than today. After all, it was Warren Buffett's right-hand man, Charlie Munger, who once said, "If I can be an optimist when I'm nearly dead, surely the rest of you can handle a little inflation," while also touting the importance of just believing in America alongside Buffett himself. But now, as a realist here, we can look at the data as of this video, and it's been pretty favorable to us in terms of inflation remaining at its current low, which electrifies the green light for the Federal Reserve to just continue to reduce interest rates. And with lower interest rates and that outlook, well, that gives me all the confidence in the world to actually look into the 6 dividend stocks that I'm about to share with you all now. So with that, let's start with Robert Half, ticker symbol RHI, which provides talent solutions, or in other words, recruiting services, as well as business consulting services throughout North and South America, throughout Europe, Asia, and Australia. But as interest rates work their way down, our economic reality actually changes immensely. We can expect that big businesses will reverse course on cutting costs and kick back into gear when it comes to spending, and that leads to growth. That's going to take manpower, and that just means the ability for these businesses to expand. All in all, I'm going to pop open Robert Half's stock chart. We can see that the stock has been lagging in the red zone for some time, which makes total sense, but zoom out to the last 5 years. We can go back to 2021 and 2022 when interest rates were much lower. We saw explosive growth and overall appreciation topping 15%. But the health of the company matters, so we're going to scroll down here to see healthy revenue flows year in and year out, a balance sheet that exudes health as well, with assets over $3 billion and liabilities at just $1.4 billion. Now, as for the dividends that you're going to enjoy with Robert Half, well, it boasts a safety score of an 80 according to Simply Safe Dividends. It comes in with a yield at 3.14%, yet a rather high payout ratio of 76%, which isn't ideal. It has been maintaining, on the other hand, 19 years worth of a dividend streak while managing to grow a dividend by a sizable 12% year in and year out. But if Robert Half seems a little bit too much of a radical bet for you right now, or just not in line with your portfolio criteria, try United Health, ticker symbol UNH. Now, this one is one that I believe every dividend investor should take a strong interest in, as it's a healthcare provider with 2 segments. We have United Health, which is coverage, but then also Optum, which is their bread and butter in terms of revenue generation. That is really their circuit of care in which their coverage segment pairs well with. But what you need to know about United Health is actually, from the healthcare perspective, it's a powerhouse within the industry. And as I've been sharing, the United States healthcare system, for better or worse, is not likely going to change, at least anytime soon. So let's go ahead and click into the stock chart. We're going to see it's up over 5% on the year, but just actually took a hit and slid from $605 per share down to $567 per share after the DOJ raised their eyebrows at United Health and it had a cybersecurity breach. Either way, it was performing very well over the course of the longer term, and we see over 125% worth of appreciation on the 5-year view. And if we scroll down, we're going to see the powerhouse that it is, generating revenue year in and year out by the billions, while also maintaining a very clean, exceptionally clean balance sheet with assets topping $273 billion, with liabilities coming in at just $174 billion. But here's why I personally am heavily invested into United Health now as a dividend growth seeker. United Health scores a 99 in terms of a safety score, comes in with a lower dividend yield at 1.48%, has a current payout ratio though of 29%, yet on a 31-year dividend growth streak while delivering through on a whopping 41% average growth rate. Now, if you want to focus on more overall share price growth and less on the dividend, but not forego it entirely, you have an opportunity right now to be all in on Microsoft, ticker symbol MSFT, which I know I can spare you the introduction of, as it's the software leader of our time, which is also one of the AI pioneers of our time that recently just gifted us with a major opportunity thanks to projecting some weaker near-term guidance, which spooked a heck of a lot of investors, resulting in the stock share price sliding to $410 per share from over $342 per share. However, zoom out with me to see the year-to-date view and see that we're up over 10% worth of appreciation, but more importantly on the 5-year view, we're going to see over 185% worth of share price appreciation. And as we scroll down, of course, you're going to see a healthy, profitable company that continues to deliver through on balance sheet health as well. Now, Microsoft isn't your run-of-the-mill go-to dividend stock, as it's really a tech investment by nature, but I don't believe us dividend investors should overlook it at all, especially when we tap into Simply Safe Dividends. We're going to see a safety score of a 99 in terms of dividend safety. It gives shareholders with a small but powerful and mighty 0.81% dividend yield thanks to the 25% payout ratio, and it has been on an 18-year dividend streak, all while growing that dividend by 16% year over year. So not too shabby. But now investors, as this channel is growing and reaching more investors out there, I keep noticing that more of you are tuning in on a consistent basis, roughly 71% of you, but you're not subscribed. Therefore, I want to go ahead and ask you to lock in with me right now on this journey by actually subscribing. It goes a heck of a long way on my end, but also it's going to ensure that you never miss out on videos like these with stock ideas. Now, while you're at it, if you think these stock idea videos are what you're getting the most value from, let me know by tapping on that thumbs up button. And finally, if you want more, not just from me, but from Wall Street insiders, subscribe to my latest newsletter, The Wall Street Word. Now, it hasn't officially yet rolled out, but you can subscribe now before it does with the link down there in my description. With all of that out of the way, let's get back to it with T. Rowe Price, ticker symbol TROW, which is a global money management firm that I always talk about during times like right now, given the nature of their business. You see, T. Rowe's assets are actually squarely invested in the NASDAQ. So when tech stocks falter, like right now, T. Rowe actually tends to slide. But with interest rates actually coming down, tech is likely to have a heck of a 2025. I think T. Rowe Price is perfectly set up for success. Therefore, I like what I see right now in terms of the stock chart. We're going to see that it's actually up on the year by 3%, nominal growth there. But check this out. If we click on the 5-year view, we're going to discover a company that back in 2021 and 2022, when conditions called for it, that being lower interest rates and many investors flocking into tech investments, T. Rowe soared, which is what I actually believe we're going to experience to some lesser extent in the coming year. But I'm insanely bullish on this one nonetheless, no matter what happens. And scrolling down, we're going to discover a very healthy financial firm bringing in plenty of revenue year in and year out, while also maintaining a very clean balance sheet with assets that far outweigh liabilities. As of 2023, over $12 billion in assets and just under $2 billion there in liabilities. Now, as a dividend investor, I remain impressed with its safety score coming in at an 80, but more so from the dividend yield at 4.43%. Now, scroll down with me, because what I believe is actually a red flag more than not is this payout ratio at 58%. So just have that on your radar. However, we're going to look into that dividend streak that's been going strong now for 37 years, all while growing that dividend over the last 20-year period by an average of 14%. But we're once again going to reel it back in with some dividend growth and reliability with an opportunity with Visa, ticker symbol V. Now, yes, I have mentioned Visa time and time again on this channel because I'm not here to be an entertainer. I am here to talk about exceptional investment opportunities for my portfolio and for yours, and I think Visa is one of them. Not only is the stock one of the stocks that I'm dollar cost averaging into quite frequently and I'm focused on for 2025 thanks to the business model, which calls for technology behind transaction facilitation. Well, in other words, when you use your credit card, they're not the ones fronting the cash for your payment there, but rather collecting on the fee from the merchant thanks to your swipe. Now, that's one heck of a business model. Genius, I'd say. And so clicking into the stock chart, we're going to see plenty of growth, over 12% worth of appreciation over the last year, even though consumers actually pulled back on spending. But what happens next year when interest rates actually work their way back down and consumers feel a little bit better to spend? My prediction is more spending without any restriction. Click into the 5-year view and we're going to see that we're up over 60% worth of appreciation. And bear in mind that was all throughout a period of time when consumers actually were really nickeling and diming on a lot of purchases. The thing is, we just won't stop consuming, therefore Visa's business model is just going to work. Now scroll down to see plenty of revenue generation. More than that, take a look at this balance sheet that's depicting over $90 billion in assets with just $51 billion in liabilities. But I'm personally invested in Visa as a long-term dividend growth investor, so let's pop open Simply Safe Dividends. We're going to safety score to 99, another small but mighty dividend yield at 0.81%, a payout ratio at 22% with 15 years worth of a dividend streak. But check this out, average growth rate here of 18% year over year. But investors, if there was just one investment that I really was focused on all 2024 and still remain insanely bullish on, it's been Alphabet, ticker symbol GOOGL. We use it every day, and it's the kingpin in terms of search, while swindling literally every business in need of any form of advertising. Not only that, but this is actually the parent company to the second largest search engine in the world. You're using it right now, YouTube. And while yes, the DOJ has been all over Alphabet lately, I say bring on the split. It will only drive growth on both organizational fronts. But as of this video, we have Google trading for $171 per share, which is up by over 23% on the year. Click out to the 5-year view, we're going to see almost 170% worth of appreciation. Now think about our AI future along with companies that will get back to spending more on advertising. I think we are perfectly set up for only more revenue to flow in during 2025. But I am now most impressed actually with Google's balance sheet. Here we have $400 billion in assets, or over that, while liabilities come in at a measly $119 billion. Alphabet isn't your immediate thought, again, as a dividend investment, but be in this one for growth just like we were in Microsoft for growth. Enjoy the extra income for what it's worth at 0.47 of a dividend yield and a payout there of just 5%, which I would imagine will only be growing like Apple or Microsoft's dividend growth rate. But now let me know your thoughts on these 6 dividend stocks in the comments below. And if you're really questioning whether or not you should be buying more stocks because your portfolio is just overloaded with a lot of stocks already, you'll want to check out this video right here, and be sure to subscribe to the channel. And of course, I'll catch you in the next one.